This is Nightly Business Report with Bill Griffith and Sue Herrera.
Second quarter sell-off. Stocks tanked to start April as the possibility of a trade war takes center stage.
Take that. China does slap tariffs on more than 100 types of U.S. imports.
And cash to burn. Homeowners have record equity in their homes, and if they tap into it, what could they spend it on? All that and more on Nightly Business Report for Monday, April 2nd. Good evening, everyone. Welcome. I'm Contessa Brewer in for Sue Herrera.
And I'm Bill Griffith. Welcome aboard. Always glad to have you with us here. The New York area woke up on this April 2nd to a blanket of snow. And that chill spread to stocks as they were hit by a pair of T's today. That would be tariffs and technology. China went through with its threat to hit U.S. products with tariffs. We'll have more on that in a moment. And technology resumed its roller that we've seen over the last few months. Led lower by shares of Intel today. They were down 6% on a Bloomberg report that says Apple is going to use its own chips instead of Intel's in its Macs. That would start as early as 2020. Here's how things shook out when all was said and done. The Dow fell by 458 points to 23,644. Could have been worse, though. At the low of the day, the Dow was down about 760 points. The Nasdaq again was the biggest loser percentage-wise. It was off 193 or nearly 3%. And the S&P 500 was off by 50. Its worst start to an April, get this, since 1929. Bob Pisani has more for us tonight.
It was a sea of red on Wall Street. We saw a broad-based sell-off. All 11 S&P sectors are now in correction mode. That means down 10% or more from their recent highs. Investors were confused and frustrated by the uncertainty around trade fears and technology woes, and those concerns led to higher volatility, but on lighter volume initially. Now, as soon as the S&P broke below its 200-day moving average, that's a key technical indicator, the selling picked up steam led by Amazon. Intel also slumped on reports that Apple may soon be using its own in-house chips instead of Intel's. So looking ahead to the second quarter, is this the start of a great tech unwind? We don't know yet. Earnings are expected to grow 20% in the first quarter. That's huge, the biggest in years, and to continue along that path for the rest of the year. 20% is practically unheard of, particularly after such a long bull run. But the earnings outlook is being clouded a little bit by concerns about technology. The overall market may not be overvalued, but certain tech probably is overvalued. Semiconductors, for example, and semiconductor capital equipment stocks, which have all pulled back. Now, the problem is technology has gotten a little too big for its britches. Tech alone is 25% of the weighting in the S&P 500, far and away the biggest sector. And the big five, Apple, Alphabet, Microsoft, Facebook, and Amazon. Amazon's technically a consumer discretionary stock, but you get the idea. Those five together account for 15% of the S&P 500. And tech and financial earnings in the first quarter are expected to be almost double the rest of the S&P 500. So no wonder the market goes into a tizzy when there is even a small threat to tech earnings expectations. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Another factor here, today it was China's turn to throw a tariff tantrum, hitting more than 100 types of U.S. imports with taxes as high as 25%. Eunice Yoon has those details from Beijing.
China is making good on its pledge to retaliate against President Trump's tariffs on steel and aluminum. Over the weekend, the finance ministry said that previously announced tariffs would go into effect starting today. These tariffs mainly target American meat, fruit, nuts, wine, steel, and aluminum products, and they affect about $3 billion of goods. The Commerce Ministry said the tariffs were to balance the loss from U.S. action and suggested that the tariffs were not meant to escalate the conflict. The ministry said, "We hope that the United States will withdraw the measures that violate the rules of the WTO as soon as possible so that the trade of related products between China and the United States will return to the normal track." The tariffs impacted pork stocks in Greater China. Stocks of local pork producers jumped, but WH Group, a Chinese company which owns Smithfield Foods in the United States, saw its stock lose 8%. WH Group's imported Smithfield pork products are popular in China. Online retailer JD.com distributes for Smithfield here, and U.S. pork, fruits such as SUNKIST oranges and cherries, and American wine are some of JD's best sellers. The tariffs were a major topic on Chinese social media, with some expressing concern about the impact on consumers here. Still, the Commerce Ministry said that the Chinese public largely supports this move. Like the U.S., Beijing opened up a period for commentary by citizens as well as companies so that they could share their thoughts. And according to the government, most people said that they supported the government's efforts to protect China's national interests, and also said that they would support even tougher action against the U.S. if it's necessary. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Well, let's turn now to Market Pros for more on how trade war fears and the slide in tech is affecting overall market at the start of this second quarter. We have with us tonight Brett Ewing. He is Chief Market Strategist at First Franklin Financial Services, and James Wang is Tech Analyst at ARK Investments. Good to see you both. Thanks for joining us tonight.
Hi.
Brett, the feeling is that there won't be a trade war, that somebody's going to have to blink because nobody wants a trade war right now. But yet Wall Street acts as if there could be one. What do you think's going on here?
Well, I don't believe that there's going to be a trade war, nor do I believe that Wall Street fully thinks there's going to be one as well. I think that markets like to overreact in the short run, and combine that with the actions of the Federal Reserve and interest rates where they're going. I think you have a perfect storm to create a nice correction.
And James, when we're talking about a potential trade war, the president has pointed out that there are issues with intellectual property coming in from China and how they deal with that with the United States. How much of what we saw today with the sell-off in tech was about this trade war looming, and how much of it was just about tech itself?
I think it's mostly tech itself at this stage. A trade war is not going to hurt tech as much as it does some of the other industries. There were some specific name sell-offs today with Tesla and Facebook, so I don't think it's really the trade commentary, but more in the tech sector. And
actually, you think the sell-off in Facebook has been overdone, right?
It has been overdone. I mean, Facebook is not a perfect company. It hasn't managed privacy very well, and they're taking steps to address that. But Facebook is now has a cheaper valuation than Walmart, which I think is the clearest sign that it's way overdone.
So at this point, do you think it's the time for people to jump in? Facebook has seen a deep dive in its share price. Could this be a good buying opportunity?
I think retail investors generally should not be trying to time the market. They really should take themselves out of the equation as much as possible. So being invested in products that auto-balance like ETFs and doing just dollar cost averaging. Right now, if you just do that methodically, yes, right now would be a good time to buy because the same great companies are now selling at a discount.
Brett, you use that word correction. People have been waiting for one. Clearly, we've got something going here and have for the last few months. Are you ready to step in yet, or do you think there's more downside to come here?
Look, I think the last time we've been in this position where we broke the 200-day moving average was the Brexit event. And if you look back at that time period and you look at the underlying economy back then relative to where we are today, that was a great buying opportunity back then. And if you look at the economy today, I think it's much, much stronger and has some catalyst to upside here with the recent fiscal policy. But we'll see how that works out.
Do you step in and buy the technology, which has been the leader to the upside and to the downside, or is there another group you prefer?
You know, the way we look at it, it's been a broad, nice breath on the sell-off, double digits across the board from the intraday highs this year. And we would tell if our clients have a long enough time horizon, we think it's a great opportunity to put some capital to work here.
And at this point, James, do you think that there are specific stocks that you're looking at, specific companies that you think represent an incredible value during these volatile times?
You know, the sell-offs for Facebook and maybe Google can be justified based on the concerns about their advertising business. Not all the FAANG companies are the same. The companies that have a direct business model or relationship with the consumer, like Netflix, like Amazon, they've been sold off for no reason at all. So we think those are great names. We're actually bullish on all the FAANG names and continue to be. So I think investors can be selective, and there are good opportunities in the market.
What about Amazon, though? The president has taken aim at that company with their tax situation, and he feels like that they're taking the post office for granted as well. You don't see that as a big headwind for this company?
Amazon is keeping the post office alive. I mean, if it weren't for the Amazon packages coming through every day, I don't know what the post office would be delivering. I think the president generally has a pretty good sense of what is good with populist sentiment, and in this case he may have made an error because Amazon is extremely popular with consumers. Consumers do not have a problem with Amazon or any of their business practices. They enjoy the low prices, and I think they will continue to like the company.
Brett Ewing with First Franklin Financial Services and James Wang with ARK Investments. Thank you both for joining us tonight.
Thank you.
While there are likely to be a lot of losers in a trade war, California has a lot on the line, and the fear is the Golden State could become a trade war casualty. Aditi Roy explains.
U.S. farmers are hard hit from China's announcement of tariffs on 128 U.S. products. The list includes $3 billion worth of items, $2 billion in agricultural products alone. Trade experts say the impact could be far-reaching and could send farmers scrambling to find other buyers.
So when you're not able to export, the product is going to be sold somewhere, and it's going to have definitely a price-depressing impact on those products.
Among the top states affected by the tariffs, California. Last year, the Golden State exported $16 billion worth of goods to China, topping all other states and making China its third largest trading partner. The state supplied nearly $2 billion worth of agricultural exports to China, but the tariffs could cut into that revenue. Fruit, nuts, and wine are California's staples and on the list of products subject to tariffs.
In dealing with China, they take so much, and it's such a wide variety of products, it impacts a lot of agriculture. It has been a key market, obviously, in the Asia-Pacific space, certainly a growing market.
It's not just California exports that could be affected by a trade conflict between the U.S. and China. In 2016, the state received $16 billion in investment from China. That's more than any other state received, according to the economic consulting firm, the Rhodium Group. Some analysts say trade tensions between the two countries could hurt that investment and cost jobs. Wine is another key export product on the tariff list. It's also becoming increasingly influential. Trade group The Wine Institute reports U.S. wine exports to China grew 450% over the last decade and totaled nearly $200 million last year. Most of that wine was from California. Elsewhere in the country, farmers are still bracing for more possible tariffs. Soybean farmers like Brent Bible are especially on edge. While soybeans didn't make the current list of tariffs, they account for more than half of all U.S. agricultural exports to China, and some worry they could be targeted next.
It's the difference between a profit for the year and a loss for the year.
Pork is another key item that was on the tariff list. The U.S. exports more than $1 billion worth of pork to China, and that product was slapped with a 25% tariff. In response, the National Pork Producers Council issued a statement saying it was disappointed in the new tariff and are hopeful it will be short-lived. For Nightly Business Report, I'm Aditi Roy, San Francisco.
Well, there was at least one winner in today's sell-off. That was insurer Humana, which rose on word the company is reportedly talking to Walmart about strengthening their existing relationship. Humana rose more than 4% on the day, while Walmart was down about 4%. Bertha Coombs has the story for us tonight.
Walmart has been expanding its online retail business to attract younger consumers, but now the retailer may be looking to make a bigger push into consumer health to service its older customer base.
If this deal could happen, there could be synergies which will drive more people into the stores. And don't forget, a customer that's pharmacy plus grocery is about 3.5 times more productive.
The retailer has pharmacies in most of its stores and has had a co-branded Medicare drug plan with Humana for a decade. Sources say a merger between the two is unlikely, but an expanded partnership could help both in an increasingly competitive Medicare market. Humana could help the retailer expand health services beyond the pharmacy for its senior customers with in-store clinics and through its growing home services.
The longer-term question in healthcare is how much of it will be a touch business, which in my opinion will always be, and that means you need a physical presence. But I think the key for Walmart will be to access the home health element here, and Humana's focusing on senior citizens.
For Humana, Walmart could provide a bigger customer base to compete with insurance rivals like United Healthcare, which has overtaken Humana as the #1 Medicare Advantage insurer. CVS's pending $69 billion acquisition for Aetna also threatens to shake up the Medicare market even more. If the deal is approved, the combined firm could offer compelling medical and drug benefit coordination, as well as primary care services in CVS's 9,700 pharmacies nationally. These would be new healthcare models that haven't been tested on such a big national scale. But the competition to win at these new integrated businesses could be a boon to consumers.
We want those savings to flow back to customers, though. And for it to flow back to customers, you need to have a competitive insurance market that forces an Aetna or a Humana to compete on premiums and return savings back to customers. So I think there'll be a lot of scrutiny to make sure that happens.
Neither Walmart or Humana would confirm their negotiations, but with the changing landscape in healthcare, most analysts say some kind of alliance makes sense now. For Nightly Business Report, I'm Bertha Coombs.
Well, let's take a look at some of today's upgrades and downgrades. Jefferies upgraded Tesla to hold from underperform ahead of quarterly production numbers expected out for the electric car maker. The Jefferies analyst said Tesla is likely to miss its own estimates again, but still top lowered Wall Street expectations. The price target here is $250 a share. Today, Tesla shares closed down at $252.48. That was down 5%. RBC Capital is raising its rating on Darden restaurants to outperform from sector perform. The firm cited the company's valuation as appealing following a recent pullback in shares of Olive Garden's parent. The price target was raised to $97 from $93. Shares closed off 1.5% to $84.07.
RBC also upgraded shares of payroll processing company ADP to outperform from sector perform. RBC says it sees an improving growth story there and better valuations. So the price target was up to $130 from $119. And today ADP shares closed at $113.30. And Morgan Stanley is cutting shares of Fitbit to underweight from equal weight. Morgan Stanley says that it sees downside as the company struggles to stabilize its revenue. The firm has a 12-month price target now of $4 a share, and shares did head toward that number today, losing more than 9% to close at $4.62.
Well, coming up, while you're filing your taxes for this year, a heads up for people in the Northeast. It's not a snow warning this time, but rather salt. We'll explain.
Music streaming company Spotify is scheduled to begin trading tomorrow at the New York Stock Exchange. The company is entering a very crowded market, though, that already has some big players. Julia Borston takes a look at how Spotify stacks up against that competition.
When it comes to streaming music subscribers, Spotify is the clear leader, but it's facing growing competition, a risk factor investors will weigh when it starts trading Tuesday. Spotify has 157 monthly active listeners, and nearly half of them are paid subscribers. That's almost double the next in line, Apple Music, which announced last month it has 38 million subscribers. And Pandora comes in last with about 5.5 million paid subscribers. Spotify projected it'll grow its subscribers as much as 36% this year to between 92 and 96 million.
Spotify doesn't have to outperform. We're at the early days of the music streaming revolution. It doesn't have to be one winner take all. Competition is good.
But Apple Music is growing fast, adding 2 million subscribers in about a month, with 8 million people in free trials. Not to mention Apple's advantages. 500 million people visit the App Store weekly, and it's integrated into iPhones in the HomePod. And while Pandora's shares are down almost 60% over the past year, it's not out just yet. Its subscription tier is just a year old, and it only launched on the web in February. And then there's Amazon Music Unlimited, the company saying today that it has tens of millions of paid subscribers, doubling its subscriptions in the last 6 months. And that's not all. Google Play Music has been around for about 5 years with no official subscriber count. Despite its rivals' deep pockets, Spotify scored a big win this weekend. Taylor Swift shot a video for her new song Delicate just for Spotify. A total turnaround from Swift's boycott of Spotify 4 years ago, as Spotify says most of artists' reservations about the platform have been addressed. It also shows how video could be the next battleground for all these music streaming companies. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Shares of biotech Alkermes fell after the FDA rejected the company's drug application, and that's where we begin tonight's market focus. The agency rejected Alkermes' experimental depression drug, saying there wasn't enough clinical data proving the treatment's effectiveness. The FDA said more tests are needed before Alkermes can reapply. Alkermes says it strongly disagrees with the FDA's conclusion and plans to appeal. Shares plunged nearly 22% to $45.23. Higher egg prices helped Cal-Maine Foods report revenues that rose more than expected. Earnings fell short of expectations. Shares fell nearly 1% to $43.30.
And shares of Snap were pressured after Wall Street firm MoffettNathanson said that users are unhappy with the platform's redesign. The firm said that it hosted 3 different focus groups, then found that each group was dissatisfied with Snapchat's new layout. Moffett therefore reaffirmed its sell rating on the stock. Snap shares fell more than 8% today to $14.46. And CBS is reportedly planning to make a bid for Viacom that is below market value. Reuters says CBS is expected to make its initial offer in the coming days, and if a deal happens, Chief Executive Les Moonves may stay in his role for at least 2 more years. Both companies lower in today's trade.
The April 17th deadline to submit your tax return is quickly approaching. And while next year's tax season may not be on your radar just yet, there are some important changes caused by the federal tax overhaul that many taxpayers need to be aware of, especially in the Northeast. But you probably already knew that. Elon Mui has the details.
It's April, and that means tax filing season is upon us. The deadline to submit your return is on April 17th this year, but it's never too early to start thinking about what you might owe next year under the new U.S. tax law, especially if you live in New York, New Jersey, Connecticut, and California, because there's a very good chance that your bill will go up.
A recent analysis from the Tax Policy Center found that more than 8% of taxpayers in these states, as well as Maryland and D.C., will see an increase under the new law. That's the most of any states in the country. For New Yorkers, the bad news gets worse, because even if you're getting a tax cut, it's going to be smaller than just about anywhere else, less than 1.5% on average, compared to the national average of 1.7%. The culprit? The new $10,000 limit on state and local tax deductions.
We had to restructure our tax code to avoid the attack. They launched a missile. We were standing in the target zone of the missile because of our tax code, our state taxes, and our property taxes. We literally had to flee the zone we were in.
To get around the new federal law, New York Governor Andrew Cuomo struck a deal that turns property taxes into charitable contributions to the state and gave workers the option of converting income tax into a payroll tax. But it seems unlikely that the IRS and the U.S. Treasury will get on board with that idea.
But I think it's one of the more ridiculous comments to think that you can take a real estate tax that you're required to make and dress that up as a charitable contribution.
Both sides are gearing up for a fight. For Nightly Business Report, I'm Elon Mui in Washington.
Coming up, homeowners are sitting on a record pile of cash. So how will they put that money to work? Some possible answers when we come back.
Rising home values are making homeowners across the country richer than ever before. The amount of equity they're able to tap into is now at the highest level on record. Will they use it, and how? Diana Olick takes a look for us.
You can thank fast rising home prices and tighter lending standards for the record amount of tappable home equity available to homeowners today. That's the amount of equity above and beyond 20% of the home's value, which is what lenders require for you to cash out.
$5.4 trillion at the end of last year, total, or nearly 3 times what homeowners had during the recession and 10% more than they had at the peak of the last housing boom. It rose by $735 billion just last year as prices soared. Unlike during the last peak, though, today's homeowners are far more conservative. Last year, they took out just $262 billion via cash-out refinances or home equity lines of credit, commonly called HELOCs. That's barely more than 1% of all available equity, which is a 4-year low. And it's not that they can't. More than half of all the equity is held by borrowers with very high credit scores, meaning easy candidates for HELOCs, which are expected to rise more this year. So what will they spend it on? Remodeling, which is projected to rise dramatically this year to the highest level in more than a decade. People are choosing to stay and renovate rather than move.
That's because there's so little for sale, a record low level of listings, even though spring has already sprung, usually the busiest season of the year for housing. For Nightly Business Report, I'm Diana Olick in Washington.
And before we go, another look at the sell-off to start this second quarter on Wall Street. The Dow fell by 458 points to 23,644. The Nasdaq was down by 193. The S&P down 59.
Yeah, these are sweaty palm days on Wall Street.
They are, that's for sure.
That's Nightly Business Report for tonight. I'm Contessa Brewer. Thank you for watching.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.